Placing stop losses can be a tricky thing to do. However, there is a method of placing stop losses which gives your trade enough room to breathe, but also prevents you taking unnecessary losses. That's by using what's called dynamic stop losses. In this video, I'll explain to you what a dynamic stop loss is and how you could use it in your trading.
Using a dynamic stop loss can be a very effective way of limiting your risk, but at the same time giving your trade enough space to breathe. Now let me explain to you how you use a dynamic stop loss. The clue to using a dynamic stop loss is in the title. Dynamic, in other words, meaning changing, adaptable. So let's take an example from the 26th of May this week. Now on the 26th of May this week, I posted on the HYCM blog that we were looking to buy the Australian dollar Japanese yen currency pair. The reason was that the risk tone had improved on optimism about a potential COVID-19 vaccine. That led to US stocks moving higher, and the company Novavax announced on the Monday of that week that it started its first human trial on its coronavirus vaccine. This was taken to be excellent news by the market, and in this market, the Australian dollar as a high beta currency would be expected to gain value. So I was expecting Australian dollar strength for the session alongside the New Zealand dollar and the Canadian dollar. On the other hand, we would expect safe haven flows out of the Japanese yen. Therefore, we had a strong currency, the Australian dollar, against a weak currency, the Japanese yen. So we were favouring buying that currency pair. Now, we expected to see more upside in the Australian dollar Japanese yen. Now, the way you used a dynamic stop loss was as follows. You would have put your stop somewhere well out of the way of recent prices. So you could have put it down here at just underneath the 70 handle, maybe just underneath that recent swing point. Now, you're not intending for your stop to be hit. You're going to use a dynamic stop loss. Now, what would happen is as follows. We were basing this trade on global growth optimism for the coronavirus vaccine. So we were identifying a couple of reasons that would negate this trade. So one of the trade risks, which I put, was that any negative news on the COVID-19 will change this sentiment, and any negative rhetoric or action between the US and China would also be able to change sentiment. So we knew the two triggers that would change the outlook for the Australian dollar Japanese yen. One, any negative COVID-19 news. Two, any negative US-China trade news, or could have been any China-Australia negative trade news. So that was the reasons we had to abandon the trade. So if during that trade it suddenly became relevant that there was some US-China trade tension or negative COVID-19 vaccine, we'd expect the Australian dollar Japanese yen to start moving lower, but then we wouldn't wait for our stop to be hit. We would use a dynamic stop loss and exit the trade prematurely before the stop was hit because the reasons for the trade has changed. That's how you use a dynamic stop loss. Once the reasons for the trade has changed, there's no need to wait for your stop to be hit. You can just exit your position, take a minimal loss, but also you gave yourself the maximum chance of the trade moving in your favor. So that is how to use a dynamic stop loss. And each day on the HYCM blog, I post a reason for a strong and a weak currency, and I also post the reasons that would change the outlook, and you would prematurely close the trade using a dynamic stop loss system. I hope that, guys, helps you to realize how to use a dynamic stop loss and how it gives you enough space for the trade to breathe, but also minimizes the risk that you have in the market.